Good day. For this session, we are going to discuss about statement of cash flows. Now, you can see on the picture a sample financial statement that is statement of cash flows. So statement is one of those financial statements found in the complete set. And then we will go back to this sample as we close this particular topic or standard or lesson. All right, so let us go back to the PowerPoint presentation, which is all about statement of cash flows again. Here are our learning objectives so that we will be guided that at the end of the chapter, we can do these following intended and achieved learning outcomes. So the first one is to describe the statement of cash flows. What is statement of cash flows? That could be one question. Then second is to differentiate the activities found on this financial statement. And the third one is to state the classifications of these particular items. So we have the dividends received, dividends paid. So two items for the dividends and for the interest. We also have two items, the paid and received. So how do we classify these items? Now these items are highlighted because normally they are the items with certain options as to the classifications in terms of the previously mentioned activities in learning objective number 2. So basically we can notice that one talks about the receipt, meaning an inflow, which is a type of cash flow. By the way, there are two types of cash flows. We have inflows, meaning plus for the cash flows of the company going in the company. Well, another one is the outflow, which means going out of the company. And these are the payments or disbursements. All right. So to answer the first objective, what is a statement of cash flows? So we have the statement of cash flows as follows. So the statement of cash flows will provide the following information about the sources and utilization. So if we say utilization, that means the historical changes as well as the sources, of course. So IE means that is historical changes. Take note for financial accounting and reporting, we are going to deal with the historical transactions which are being recorded, summarized, and we follow the processes of accounting along the way. Then of cash and cash equivalents during the period. So we have to know also that if we say cash, that not only means the legal tender, meaning if we say legal tender, it is the money that we can make use of buying or entering into any, for example, buying transactions anywhere in the Philippines. So if we are going to buy from rural areas or even to remote places or islands, we can make use of the money for acquisition of certain items. And that means, or which means legal tender. Then the statement of cash flows presents cash flows according to the following classification. So we have here the three activities. We have operating, investing, and financing activities respectively. And then we have the activities being discussed here. So if we say operating activities, this has to do with the normal or routinary business activities. So any activities that would involve inflows or outflows of cash and cash equivalents for, let's say, monthly basis. That's the least accounting period as you have known from IAS 1, as well as, of course, we have the quarter, semester, and a year as the accounting periods. So, for example, if we talk about the collections of the accounts receivable, the sales of, let's say, goods in cash basis, or for example, the payments of any expenses or liabilities. So these are done in the short term and in the accounting periods considered. And that's why they have to be part of operating activities. So normally they are part of the determination of profit or loss. So if we have known so far that profit or loss would simply mean the difference between income or revenues and expenses or less expenses. And so if there is a cash transaction that would affect or have impact on the revenue and then also with the expenses, then they will have the impact also on the determination of profit or loss. Then these transactions normally affect income statement accounts. And that is actually the right thing to think about. So income and expenses, or another term for income again is revenue. Now, well, there are also some items that may be considered at this point in time, most especially if we prepare certain statement of cash flows, but that will be tackled as we go along the way. So we can just actually think of a T account, which summarizes the transactions that can happen in an accounting period, and we just have to segregate them into the different activities. So operating, investing, and financing. So if we say investing, on the other hand, we talk now about any cash inflow or outflow that would have impact on the long term or non-current assets and other non-operating assets. So if number one, we'll talk about the current assets and liabilities, meaning changes in working capital. Hopefully you're taking that down. Number two, we'll talk about long-term assets and other non-operating or non-current assets. Examples would be, let's say, we acquire property, plant, and equipment items. So those items that we can make use in the operations like the land, building, machineries and equipment, furnitures and fixtures, etc. So if we are going to acquire them, that's an outflow, or we are going to sell them, that's an inflow, then that would be part under investing activities. As what I've said, cash flows can either be inflow, the plus, or outflow, minus. Number three, we have the financing activities. So what's left? We have the non-current or operating liabilities or long-term liabilities and the items in shareholders' equity. Although again, there is an exception to the rule for short-term liabilities that is under operating. If, for example, that is going to talk about, let's say, the borrowing of money and then the company issues promissory note. So that short-term note payable or notes payable will be part of financing on the sense that it is being there in order, or it is being made in order to borrow money, which is an essence of financing activities. On the other hand, for let's say short-term investments or short-term investing activities, like other than the so-called marketable equity securities or trading securities, normally they're also part of investing because they are there in order to have investments. All right. Or to earn something, most especially that is more than the 3 months, but within 1 year. So they are part of investing activities. All right. So here are some examples, though, of cash flows from operating activities. As what I've said, they can happen, of course, within the ordinary course of the business. So we have here the cash receipts from the sale of goods, rendering of services, or other forms of income. So these are the sources of income. Then we have the cash payments for purchases of goods and services. Again, to emphasize that all other things here should be talking about either the pluses, the inflows, and the minuses, the outflows. Then operating expenses such as employee benefits, like the salaries, payments of such, insurance, and the like, or refunds for the payments of income taxes or any other types of refunds wherein we pay someone or somebody or any entity, then that's part of operating activities. Then delta will be, for example, for contracts held for dealing or trading purposes. If we say trading, it means buying and selling. So that's why we have here the receipts and payments. Receipts for the selling and payments for the buying, respectively. All right. So for investing activities, again, we are talking about non-current assets or long-term assets. So we have here the PPE, the investment property, intangible assets, and other non-current assets. Also, if you talk about investments other than cash equivalents or held for trading, so if we talk about, for example, let's say that is more than 3 months, more than the banking days, but less than the 1 year or within 1 year. So that's still part of investing. And then also if we talk about derivative assets and liabilities other than held for trading, because normally derivative assets are being held for trading and then or classified as financing. So in that case, part of the investing. All right. Then what else? Loans to other parties and collections thereof. So these are the loans receivable, which are long-term receivable. So they're part of non-current assets, therefore part of investing activities, other than loans made by a financial institution. So of course, if we are going to talk, for example, if our business is a bank, let's say any bank, and then normally the bank would lend money to certain individuals and businesses. So on the financial statements of the banks, it would be saying their loans receivable. And so although it's loans receivable and it is long term, it is not part of investing. Instead, it is part of operating. Why? Because extending loans or providing loans to individuals and institutions is actually part of the operations and normal operating cycle of a financial institution, for example, a bank. I hope that is clear. Next, for financing activities, again, we have the long-term or non-current liabilities and the equity. So we have here the issuance of shares and other equity instruments. And what if we are going to buy them back, which is called redemption? So redeem is to buy back them. Then letter B is for the issuance of long-term liabilities and their payment. So example would be notes, loans, bonds, and mortgage payable, and other short term. So I said a while ago, if we borrow money, even that is short term, but it is in a form of a note, loan, bond, and mortgage, then that's going to be part of financing activities. Now, for notes, that is with the evidence of promissory notes. A loan is normally that is made from a financial institution. Although we can sometimes refer that as a loan or note, but then some are just anyway like subclassifying them. So if we say note, that could be from any other entity other than a financial institution like bank that we borrowed money. In case if we borrowed money from the bank, so that's loan payable or loans payable. If, for example, we want to have sources of money and then it's like a long-term notes payable, then with a certain unconditional sum and there's interest, and we can also refer to the changes of fair values in the market. So that's going to be bonds payable. On the other hand, if we say mortgage payable, this is actually the account if, for example, we are going to, let's say, borrow money from a bank, could be a loan with collateral. So there has to be a property that is mortgaged for the protection of the bank just in case we fail to pay such. All right, that's for letter B. Next, for letter C, this is for a lease contract. If you say a lease contract, it's like a rent. We are allowed to make use of certain premises of a certain owner of a property, and then we are going to make payments in a form of lease or rent. So cash payments by a lessee for the reduction of the outstanding liability relating to a lease will be part of financing. So this is something that has to do with a finance lease normally. So if we say a finance lease, it's like we are paying for the rent, but later on we have chances of either really acquiring it as our own property, or we are already using it for the majority of the life or significant life of the property. So you will have to meet that anyway in the future for a finance lease. Then after this one, we have, can we go back? Okay. So we have to remember the following items, but then again, I've said this a while ago that we have for operating activities, this has to affect the current assets and current liabilities and would affect the profit or loss, income or expenses. Then for investing, the non-current assets and other investments. For financing, that would have impact on the borrowings and equity. After that, we have the core principle to take note that when preparing statement of cash flows, we include only the transactions that have affected cash and cash equivalents. All right, so meaning to say, it's either we debit cash or any other cash equivalents. By the way, there's a mention about cash equivalents, but if you say cash equivalents, these are really the near cash items. So they're called near cash items because within 3 months, 90 days or less, they can be converted to cash. And the changes of values within 3 months would be insignificant or immaterial or not substantial to its face value. Face value is the amount that is given on a certain cash item and cash equivalent. So for cash equivalents, the face amount, if there would be changes in 3 months, wouldn't be material. So this has to be only a debit to cash or cash equivalent for the inflow and a credit for the cash and cash equivalents for the outflow. And that's why, for example, if purchase of assets by paying cash, then we are going to include. But if we purchase assets by not paying cash, instead we issue promissory notes or just an oral or verbal promise to pay like accounts payable, or we have, let's say, for example, issued a note plus the collateral, then we are going to, of course, we have to include that for our consideration. All right. So that's very important though. Then on another occasion, for another item here, decrease in accounts payable, this is because we actually paid our accounts payable. That's why it decreased. So that is an outflow. That's why it is a minus. And we get the cash or net cash provided by, if that is positive, or used in operating activities. Then we have here the net cash amounts for the three. We actually simplify 25 minus 21 minus 3, that's 1,000. That's the net increase in cash for this year, ended December 31, 2016. And if we add back the cash at the beginning of the year, so this will be the cash at the end of the year. So this is how we are going to present our statement of cash flows then. So thank you very much for staying with me for the discussions about statement of cash flows. Hope to see you next time for another session. And thank you and God bless.